everyone. Thank you for coming along to tonight's Farm Advisory Service webinar. I'm Laura Henderson and I will be chairing tonight. And this is the first webinar of our new Entrant Finance series, which will be running throughout February. So tonight we are looking at bookkeeping and VAT. And then next week, we will go to look at understanding accounts and accounts analysis, followed by cash flow on the 26th of February. Some of you may have attended the introductory meetings in Perth, Huntly and Lanark last week, but don't worry if you weren't able to attend or there wasn't one in your locality, because all of these webinars are designed to be standalone, so you won't have missed anything that's vital for your understanding tonight. But with the recording of tonight's webinar, we will send you the slides from that introductory meeting. All these webinars will happen at the same time, 7 o'clock till 8 o'clock. The links are there, but we will send that along with the recording as well. So tonight's webinar, as we said, is on bookkeeping and VAT, and we're joined by our guest speaker, who's Andrew Coalter, who's a chartered accountant. And Andrew worked in accountancy practice before joining SEC Consulting as a consultant, and he is based in Perth.
Tonight's webinar, we're going to cover bookkeeping and VAT. We've split it sort of into three areas. The first is, the basics of bookkeeping. What do we need to do? What records do we actually need to keep? VAT, what does that mean for agriculture? Why might we want to be registered? What are the key rates and things to be aware of? And then finally, there's a short section on making tax digital as well. As we start this process and we look at the basics of bookkeeping, what are we talking about really? So if we think about record keeping, all businesses, no matter what sort of trading structure you have, like the trading structures we covered last week, need to keep financial records. And you need to keep those financial records for a number of purposes. I suppose in a selfish viewpoint, they're helpful as a source of management information, but legislatively, we would need to keep those for VAT purposes, but also for tax purposes, whether that's income tax or corporation tax. Financial documents, so by that we're talking about, invoices, bills, contracts, any of those sorts of documents that you have are the starting point of the record keeping process and the starting point of the bookkeeping process. So fundamentally, what we need to remember is that for every transaction that you have going through your business, whether that's a purchase or a sale, any sort of income or expense, a document will exist for that in some format. So if you think about a sale or income that you receive, generally speaking, there will be an invoice for that. You'll have received a receipt for it. If it's grant funding, you'll receive some sort of acknowledgement. On the other side, if it's an expense or a payment, you'll be able to see that again through an invoice that you've received, but you'll also be able to see payments going out through your bank account, through your check stubs, whatever it may be. I will note that we do have quite a large number of slides to get through, so we'll be trying to keep a reasonable pace. If there's anything that I covered that isn't clear, flag it up in the chat box or in the question and answer box, and we'll make sure to keep covering things as best as we can. So we've got all our invoices, we've got all our sales documents, we've got our bank statements and everything else. What do we do with that? In a very basic format, you provide that to your accountant at the end of the year. They'll take that information and that's what they use to produce your financial statements for your business. Once your financial statements are produced, the profit or loss that your business makes is then used to help calculate the tax payable by your trading structure. So if you're a sole trader partnership, that'll be used in your own income tax calculation. If you operate as a limited company, the figures in your accounts will then be used to help calculate corporation tax and the taxable profits that are seen there. So there are some rules about how long we need to keep records for, from a legislative point of view. HMRC require you to keep your records at least 6 years from the end of the financial year. That's the way to remember it. And also for VAT, you need to keep your records for at least 6 years from the submission of that VAT return. A helpful point to note, especially when we get on to talking about making tax digital later on in the evening, is that HMRC allow digital record keeping, and that's something we see much more of now. It used to be the case, particularly as an accountant or doing some bookkeeping, that clients would come into me with literally a bag full of books or a folder or a folder full of paperwork. And that's not necessarily the case anymore. Most of the things we deal with now can be dealt with online. A lot of trade invoices can be emailed to you or perhaps sent straight to your accounting software. Banks automatically link up to your accounting software as well. You don't have to keep those records in paper. You can choose to, but keeping a digital record of those in some sort of soft format like PDFs and the bank statements you keep on your computer is absolutely fine. Paper records are still absolutely acceptable, but you would need to keep them well organized if you ever asked for them. So that's the actual records that we need to keep. So what do we mean when we talk about bookkeeping? So what we're doing in our bookkeeping is we're effectively recording those financial transactions in an understandable and a usable format. And we record those in a timely manner, and that allows us to summarize all of the financial transactions that have happened within any specific period. By that, I mean that we could take a 12-month period, which is your accounting period, and create your annual accounts, your financial statements. You might be wanting to summarize the period of your VAT return, whether that's monthly or quarterly, or it might be the case that if you're doing your own review of your business as a management tool, that you're reviewing whatever period you need to be. It might be that you're comparing this year with last year, or this quarter with the same quarter last year, whatever it may be. Using that, if your bookkeeping is completed, you can then take that information and produce reports, which will help you make your own management decisions from the back of that. So what records do we actually need to keep? A lot of this is quite straightforward and will be obvious to you. Invoices, that's really clear. Any invoices that you receive, so for things that you're buying, or any invoices that you send, either for things that you're selling, or it might be the case that they're self-billing invoices in there as well. Original copies, by original I really just mean paper copies or electronic copies, are absolutely fine. If there's any credit notes issued, whether that's for purchases or sales that were cancelled for whatever reason, keeping a copy of that. If there's any items you can't reclaim VAT on, or goods that, private use, keeping a record of those so that those can be tracked. Ultimately, we're talking about your general business records here: bank statements, cash books, check stubs, a way that we can reconcile all of the financial information and all of the transactions associated with your business for the accounting year and for the period that we're looking at. So really then we move on to VAT. VAT is a regular check-in point for your bookkeeping. To be honest, for most of us with an agricultural business, when we come to complete our VAT return, that's the point at which we get our bookkeeping up to date. We will come on to the different types of VAT schemes and reporting periods, but broadly speaking, you can do a VAT return either monthly or quarterly, and that choice is completely up to you. But before we even get that far, the question is, what is VAT? Value-added tax. It's a tax on goods and services that businesses charge and collect on behalf of HMRC. So VAT is added to most products and services in some form. There are different VAT rates, and we will get on to those. Agricultural products have VAT added to them, but in many cases, as we'll see, that VAT is 0%. If your taxable turnover is more than £90,000 in any 12 months period, you have to register for VAT. That's a legal requirement that applies to all businesses. If your taxable turnover is less than £90,000, you can choose to register for VAT voluntarily. If you register for VAT, what does that mean? It means that you have to charge VAT on all of your outputs, but it also means you have the ability to reclaim VAT on all the inputs that you have purchased, in really broad terms. So for that VAT registration, if your turnover is more than £90,000, you have to do it. If it's less than £90,000, it becomes voluntary. Again, as I mentioned before, we have a choice in reporting periods. Quarterly VAT returns, that's really the most common one that I see, and will be sufficient for most people. You complete the VAT return at the end of the quarter. You would do all your bookkeeping for all the transactions within that quarter, and then submit your VAT return with all of the information to HMRC. The other option is to do it monthly. You may want to submit monthly VAT returns if you have a consistently high level of expenditure and large amounts of VAT going out every month, just to be able to get it back that wee bit quicker. And yeah, there might be other scenarios where you would want to do that, but quarterly covers the most of the agricultural businesses that we come across. So when I talk about taxable turnover of £90,000, it's important to understand what that means. So basically, your taxable turnover is the value of everything that you sell. It's the value of everything that you sell that is not VAT exempt, so i.e. there's no VAT at all. And it also excludes things that are entirely outside the scope of the VAT system. So really all of your sales that are hit the main rate, so standard rate, reduced rate, zero rate, business goods for personal reasons, things that are listed out there. I will go through each of these VAT rates in turn and explain what they mean. So hopefully that becomes a wee bit clearer for everybody as well. So if you register for VAT, you have a choice of accounting schemes. Now, what I mean by that is there's different types of VAT registration, and depending on the type of registration that you go for, there's different ways that you treat items for VAT purposes. There's different ways to report your VAT to HMRC. So the most common treatment that we see is to register on what's called the accruals basis. What that means is that we recognize VAT, we recognize transactions and their VAT at the point at which the invoice is dated, the point at which the transaction happens. Whereas if you're on the cash basis, we record VAT based on when money is paid or received. Those aren't always the same thing. Quite often, if you buy something on credit, you might not pay for it for 30 days, 60 days, or longer. So if you're on the cash basis, that would delay it. The cash basis is a slightly simpler scheme because you can really just run your bookkeeping of what happens in your business bank account. But accruals is the most common, and most accounts are based on the accruals basis as well. There is an alternative option, which is the agricultural flat rate scheme. This isn't one I see very often. It's quite uncommon. If you're in a traditional farming scenario, it's unlikely to be beneficial. But the choice is there. So actually, instead of registering for VAT, you could register for the agricultural flat rate scheme. It means you don't have to do VAT returns every quarter. You don't have to submit them to HMRC. But instead of that, on every sale that you make, you would charge 4% VAT to VAT registered customers. What you would then do is you would then keep that. You wouldn't have to pay it back to HMRC. So it's not actually a VAT in itself, but the idea is that it's an extra income for you to compensate you for the fact that you're not able to reclaim the VAT on all of your expenses. But the people you charge it to can reclaim it themselves. So it's a wee bit niche. It is for the agricultural industry, but it's not one that I come across that often. So we've got our books and records. We know what records we need to keep, how long we need to keep them for, and I'm going to assume that we are registered for VAT at this stage. So what's the basic principle here with VAT? There's two ways to look at it, and that is to look at how we deal with VAT on our outputs, and also how we deal with VAT on our inputs, so our purchases. So on our outputs, on our sales, if you're VAT registered, output VAT must be charged on the taxable supply of goods and services at the appropriate VAT rate. A really important point to note is that VAT is never an income or an expense of your business. Effectively, what we're doing is we are collecting a tax on behalf of HMRC. And if you're VAT registered, you would reclaim. So you would, and you make a purchase. Let's say we buy a tractor at £100,000 and there's £20,000 of VAT on top. You would have to pay the full £120,000 up front, but you would be able to reclaim the £20,000 back from HMRC in your VAT return. On the other side, let's say we make livestock sales of or livestock sales isn't a good example actually because there's no VAT on those. So let's say we sell a tractor also at £100,000. We would have to charge our customer an extra £20,000 of VAT on top. But actually, so we get that £120,000 into our bank account. But that VAT isn't ours to keep. We have to pay it back to HMRC. So it comes in and it comes back out again. It's not an income or an expense of your business. We're effectively just a middleman collecting that tax on HMRC's behalf. So on our input tax on the things that we buy, VAT will be charged to you by suppliers, by VAT registered suppliers on the expenses that you buy. You can reclaim the VAT on expenses, but it's important to note that you can only reclaim VAT on goods and services which have a direct and immediate link with a taxable supply. So you can only reclaim VAT if that expense is relevant to your business. So to take that point that I made, that VAT is never an income or an expense, I thought I would try and demonstrate this. So hopefully this makes sense, just to follow the chain through and show that actually, even though we pay VAT, even though we reclaim VAT, it's mostly just an administrative exercise and there's no net gain or loss to our business, or there shouldn't be. Ultimately, what it creates is timing differences in our cash flow, but it doesn't create an income for us that we can use to our benefit. So I'm going to follow the process of making a farm gate, a steel gate, a field gate for cattle and sheep. So we've got a steel supplier who's creating the raw steel. I've said the amount of steel that they need to produce for one gate is going to cost the blacksmith £50. So the steel is sold by that steel supplier at £50 plus VAT. So we've got £60 in total. The gate is then made from the steel and then is sold on to the farmer for £100 plus VAT. I'm assuming here that everyone in this chain is VAT registered, that they're charging VAT and they're reclaiming VAT on their VAT return. So actually, how does this follow through the process? I don't know if you can see my mouse on the screen here, but I've got the steel supplier. So they have sold the raw steel. They've manufactured the raw steel and they've sold it to the blacksmith. So actually, they have collected £60, but 10 of that is VAT. So they've collected £10 of VAT. The blacksmith, on the other hand, has had to pay £10 of VAT. So between them, this transaction has a nil impact. The gate that's then made by the blacksmith and sold to the farmer. Again, the blacksmith collects £20 of VAT from the farmer when he sells the gate. It's charged on top of the £100, and the farmer has to pay it. So again, we've got a plus 20 and a minus 20. It nets out. It's really neat. The net impact on their VAT return is the other way to look at this. So actually, for the steel supplier, they've collected £10 of VAT. So when they come to do their VAT return, they need to then pass that on to HMRC. So they've collected it, they pass it to HMRC, there's absolutely no impact on their business. There's no profit or loss for that steel supplier. For the blacksmith, they've bought the steel, so they've had to pay £10 of VAT. They've collected 20 when they've sold the gate. So actually, it means that overall, they're up £10. So that £10 that they are up is due to HMRC. So they pay it to HMRC in their VAT return. The poor old farmer at the end of the chain, he's bought the gate. He's nothing to sell here. So he's paid £100 for his gate and he's paid £20 of VAT. Because he's paid it on a relevant business expense, he's able to reclaim that. So even though he's paid it out, at the end of his VAT return period, he reclaims it back. So the total impact on all of these businesses, as you can see, is absolutely nothing. So it really just creates a timing difference. So businesses collect VAT on sales and reclaim VAT on purchases. We're effectively tax collectors. Only a non-VAT registered buyer bears the final cost. So in this example, if the farmer wasn't VAT registered, then they wouldn't be able to reclaim that £20. And actually, it would have an impact. It would be an extra expense to them of £20. What's probably a better example is ourselves as just members of the public. If we go into the shops and buy goods, loads of goods that we buy on a day-to-day basis, most of them have VAT on them. We're not using those for a business, they're personal for our lives. So we can't reclaim that VAT. So actually, VAT is always passed on the whole way through the chain to the end user. But in our case, in agriculture, if we're VAT registered, we're able to reclaim that. So it's never an income or an expense. So what are the VAT rates in the UK? I will take each of these in turn, but there are ultimately 5 rates that we need to think about in the UK VAT system. The first is standard rate VAT. So that is 20% VAT that is charged on top of an invoice. That's our standard rate. That applies to most goods and services within the UK, not necessarily agriculture, but most goods and services within the UK. There is a reduced rate of VAT of 5%, and we'll get on to scenarios of where that applies. There is a 0 rate, and there is also an exempt rate. There is a difference between the two. 0 rate VAT, we charge VAT, but we charge it at 0%. And also, if it's exempt, we don't charge VAT. So it's so there's no VAT actually being charged at all. Finally, things that are outside the scope of VAT or don't have VAT are separate again, and we show those separately. These VAT rates will generally be set up for you in your accounting software. And when you're completing your bookkeeping, as you're going through and your record keeping, as you post these transactions to your account software, you would need to be keeping track of what VAT rate applies to each transaction and make sure you're using the right code. But our accountancy software quite often does the legwork there for us. So I wanted to give you some examples of some VAT receipts and what we need. So I've said that we need to keep records, we need to keep our invoices, we need to keep our expenses, we need to keep our bank statements, all of these things. What do we need to qualify as a valid VAT receipt? To be able to reclaim VAT, there's a number of requirements. It needs to have been a genuine expense for your business. It also needs to come with a VAT receipt. What does that VAT receipt need to show? It needs to show your name, your business name, your business address. It also needs to show the address of who has sold you those goods or services, their VAT registration number, and how much VAT has been charged. There is an exception to that, which is for invoices that are worth less than £250. In that situation, like we see in the diesel receipt that's on the screen here, we don't need to specifically show the total amount of VAT that's on that bill. But as long as there's a VAT number, which there is here down at the bottom of this Tesco VAT receipt, that shows us that actually VAT's been applied. Actually, no, I'm incorrect here. It does show you 20% VAT, but it doesn't always show you. Sometimes it just shows you the total with a wee asterisk beside it. But if the VAT number's there, that's a valid VAT receipt that we can claim. In the case of this tractor on the left-hand side in the screen, you can see here has been addressed to the farmer, and we can see that it's come from Netherton Tractors. Their full address is on here, and also their VAT number is also on this invoice as well, down the bottom of the screen. To be able to reclaim VAT on any goods or services within your business, you do need to be able to produce a VAT invoice in support of that claim. As the value of that claim increases, obviously the importance of holding on to those documents increases as well. But for any expenses where you're reclaiming VAT, you should hold a valid VAT receipt. So again, the basic principle here is that output tax, so this is on goods that you sell, must be charged on the taxable supply. It's never an income or expense of the business. And for input tax, it can only be reclaimed on goods and services which have a direct and immediate link with a taxable supply. There must be genuine expenses that are directly linked to your business. So the first one we need to consider is the standard rate of VAT. So that's 20% VAT. This applies to all sorts of things in agriculture. Plant and machinery is the big one. So if you were to buy a tractor, new, second-hand, it doesn't matter, any sort of machinery, those sorts of things, VAT is charged on those by your supplier at 20%. Similarly, if you sell a piece of machinery, you have to charge 20% VAT on it if you're VAT registered. Your contractors will be charging you VAT at 20% if you're hiring in machines, that sort of thing. So there's lots of examples on the screen. Veterinary services, bedding materials, sawdust, wood, fines, those sorts of things have VAT at 20%. Wool is another one. That's a common output for a lot of our businesses. I appreciate we might not get a lot of money in for it, but VAT is payable at 20%. All of the VAT rates are set out in legislation. So within the VAT, specifically in the VAT legislation. So lots of these things are detailed out specifically. And as we go through, you'll see more and more examples. But if there's something you're not sure of, get advice from your accountant or from your bookkeeper or whoever you use. Fuel, there is 20% VAT on fuel, generally speaking, depending on quantities. Farm vehicles as well, a bit of a question mark on that one. Commercial vehicles do have VAT at 20%, which you can reclaim. Cars also have VAT charged on them as well, but the question mark there is whether you can reclaim it or not, and I'll come on to cars separately. So we then have the reduced rate of VAT. So that's 5% VAT. We see that in a number of things, but focusing specifically on agriculture, where do we see that? We see that most commonly in domestic fuel. So your electricity, your heating oil, your gas, those sorts of things. A lot of those expenses are partially going through your business as well. They will have a VAT charged at 5%. If you're buying business fuel where the quantity is less than 2,300 litres, it should be charged at 5%. Also, where you're getting electricity and your usage is less than 1,000 kilowatts per year, your supplier should be charging you that at 5%. If you get an invoice and you think the wrong VAT rate has been charged, the first thing to do would be contact whoever the supplier is and just question it with them and say, oh, actually, I don't think you've necessarily charged the right rate. No matter what you do, don't try and reclaim a different VAT rate than what you see on the invoice. If the invoice says that they have charged you 20% VAT instead of 5% VAT, that means that that is what they have reported to HMRC. And actually, you want to keep that consistent through the process because actually there should be no net effect. If they charge 20% and you reclaim, whereas actually if they charge 5 and you reclaim 20, that's an issue. So you should always be reclaiming what's on your invoice. But if you have an issue with the invoice, speak to your supplier in the first instance. So then we come on to zero rated VAT. So this is really commonly used within agriculture, particularly within agricultural outputs. So the big one here is livestock. It doesn't matter how you buy or sell your livestock, whether it's through the ring or straight to the abattoir. VAT is charged, but it's charged at 0%, and we say that it's zero rated. It excludes horses. Horses have a 20% charge on them. Milk, any dairy farmers on here, milk does have VAT applied. Again, it's applied at 0%. Cereal crops, grass, so hay, straw, silage, those sorts of things, all have VAT applied at 0%. Feedstuffs, so feed that you buy in for your livestock, the supplier is charging you VAT, but they're charging you VAT at 0%. So the question arises, why do we charge VAT at 0%? Why do we not just say there's no VAT? That comes back to a point I made earlier, is that VAT can only be reclaimed on goods and services which have a direct and immediate link with a taxable supply, the last point on that screen. So to be able to reclaim VAT, it needs to be an expense that's associated with your output, which is a taxable supply. So we need to charge tax on our supply to be able to recover the VAT. So if we just said, well, actually, there's no VAT on our livestock sales, that means that we wouldn't be able to reclaim all the expenses associated with it. Now, that puts agriculture in a really unique position. In lots of industries, whether that's the building trade or in professional services or whatever that may be, or even just corner shops, the outputs that they have, generally speaking, are standard rated at 20%. So they are charging all of their customers VAT at 20%, and then they're reclaiming VAT on their expenses. Hopefully their income is more than their expense. So that means they are charging more VAT than they're reclaiming. So every month or every quarter when they do their VAT return, generally speaking, most industries need to repay VAT back to HMRC. Agriculture is an exception, one of the exceptions to that, because our outputs, generally speaking, in a traditional sense, being livestock and crops and milk, are zero rated. So we're not charging people VAT on our outputs, but because it is a taxable supply, we're able to reclaim all the VAT on inputs. So that means that even if you're below the VAT registration threshold, it is likely beneficial for you to register if you're a traditional farming business, because you won't have to charge VAT on your outputs. Well, you do, but at 0%, but you will be able to reclaim VAT on all your inputs, being the feed that you buy for your livestock, being your veterinary supplies, being your fencing and materials, your machinery costs, all those sorts of things. So that's a really important point to understand. So we do have zero rated. We also do have things that are exempt from VAT. So there's not actually any VAT charged. You still have to report these transactions on your VAT return, but there's no VAT. And that would include things like rent, long-term lets, tenancies. If you have holiday lets or bed and breakfast, they are standard rated because you're providing a service over and above just the rent there. If you buy and sell land, farmland, whatever it is, there's no VAT there. Insurance doesn't have VAT, postage, other statutory charges, such as MOTs for your cars, whatever it is. There's no VAT on these transactions. You'll still need to report these transactions within your VAT return to say that they have happened, but there's no VAT to consider. Finally, we come on to our last VAT rate. I appreciate that's been a lot of information, and that is transactions that are outside the scope of VAT. So these are transactions that, while you record them in your accounts, would not appear on a VAT return. These are things like agricultural subsidies are the main ones. Your basic payment that you get every year does not have VAT on it. It's not linked. It's not linked to any sort of taxable supply. The Scottish government itself is not a taxable person, so can't charge you VAT. Payroll, so if you're paying your employees, there's no VAT on that. If you make a purchase from somebody who's not VAT registered, you can't try to reclaim VAT, even if it is a supply which normally has VAT on it. Unless you've been charged VAT, you can't reclaim it. Also, we get our VAT repayments. Generally speaking, a repayment for agriculture from HMRC. That's outside the scope of the VAT system. So hopefully that's helpful. I'm going to go on now to talk about a few specific scenarios, and hopefully these are helpful. So now that we've covered the key rates, when I talked about standard rate VAT at 20%, I mentioned farm vehicles, and I put a question mark over that one as well. So if you have a commercial vehicle, you can reclaim the VAT on that. What's the requirements of a commercial vehicle? Effectively, we're talking about a van or a pickup, a double cab pickup. Or sorry, any sort of pickup. We're talking about a van or a pickup. We're talking about a pickup with a payload of over 1 ton. So those are commercial vehicles designed for carrying goods, not for carrying passengers. VAT can be fully reclaimed by your business if one of those commercial vehicles is bought for business use. If you have incidental private use, that's permitted. In reality, that covers most cases. What we're talking about there is you could use your van or your pickup to go to the shops, or occasionally if you're bringing the kids to school, or if you're taking the occasional personal journey, that's absolutely fine. But primarily these are viewed as commercial business vehicles. Many of you might be aware that tax rules are changing on double cab pickups. Those changes are in relation to income tax, corporation tax, capital allowances. Just to note that purely for the purposes of VAT, the VAT rules are unaffected. They are not changing, and that even from April 25 onwards, we will still be able to reclaim VAT on double cab pickups. If you use a car as your farm vehicle, you're not able to reclaim the VAT on it. A car is designed for carrying passengers, primarily, not goods. That's the distinction, whereas a commercial vehicle is for carrying goods, not passengers. So you cannot reclaim VAT on a car. If you are purchasing farm vehicles and you're not sure what your position is, just get advice on it as well. If you're considering buying a double cab pickup going forward and you want a bit more advice on the changes in the tax rules that are there, again, seek a wee bit of advice on that point. So that's our vehicles, but we also need to put fuel in them. So how do we reclaim VAT on fuel? The fundamental premise of VAT that I mentioned earlier on is that VAT can only be reclaimed where the expense has a direct and immediate link with a taxable supply. In reality, not all the fuel that you put in your pickup or in your car is going to be used for business use all of the time. If there are any personal miles at all, so if there's 1 personal mile in the year, then you need to consider that, and you need to report that appropriately and make appropriate adjustments on your VAT return. So how do we do that? Basically, there's 3 ways that we can deal with fuel, and quite often we're talking about diesel here for our vehicles. The first option, which is the most common, is that you can reclaim all the VAT. So keep all your diesel receipts, claim back the VAT on absolutely all of them, and you apply what's called a fuel scale charge. I'll discuss that in a moment, what that is. The second option is that you think, do you know what, is too complicated. I don't do that. I don't do that much mileage. I'm not using that much fuel. Not worth the hassle. I don't want to reclaim any VAT at all. That's absolutely fine. The third option is you can decide, actually, I'm going to keep detailed mileage records. I'm going to record how many miles I do on every business journey, and I'll only recover the tax on those business miles. That's quite labor intensive. So most agricultural businesses I see will go for the first option, reclaim VAT on all the receipts, and then apply what's called a fuel scale charge. It might be the case that if your accountant or your bookkeeper is doing your VAT return for you, that they are doing this automatically and you don't know about it, but it's good to have an understanding. The idea here is that HMRC acknowledge there can be some private use of vehicles. So therefore, you shouldn't be able to reclaim 100% of the VAT because it's not purely a business expense. It can be quite laborious to keep detailed mileage records, so they have made some concessions and they have come up with a scheme called the fuel scale charge. It avoids the need to keep mileage records, and basically you pay a charge every month or every quarter within your VAT return to account for your personal mileage. The amount that you pay is based on your vehicle emissions. I have a link on the screen which takes you to the fuel scale charge website, and you can go through and follow it for your vehicle to find out, well, actually, how much VAT would I need to pay back. Um, I've got a screenshot here from the from the government website. I've taken my own car, so I've got a 2 litre diesel car, and it's got emissions of less than 120. So actually, it means that for a 3-month VAT period, there is a fuel scale charge of £174. If we apply VAT at 20%, it means I need to effectively repay £29 of VAT every quarter to account for the private mileage that I do in my car, because not all the mileage that I do is personal. And that applies to pickups, that applies to cars, any vehicles that you're using for the purpose of your business. If you're trying to reclaim the VAT on the receipts, you should be completing a fuel scale charge for that. So that covers off vehicles for us. Next, I wanted to briefly touch on when you're buying assets. So really this pops up quite a lot when you're buying plant and machinery. Two really common ways to buy plant machinery at the moment is to use either a hire purchase or perhaps it's just to lease the machine. For anyone who was at the meetings last week, we will have covered these and the differences between them. When you buy an asset on hire purchase, you are buying the asset, you're obtaining ownership of it, but you're buying that asset on credit. You're taking out borrowing against the value of the asset. But because you own it, because it's a genuine business expense, you are able to reclaim all of the VAT on the entire purchase up front. So to take that example from earlier of a tractor at £100,000, there's £20,000 of VAT on top of that as well. It might be the case that you're making monthly payments of £2,500 for the next few years, but actually, because you bought it, you own the asset, you're able to reclaim the full £20,000 of VAT up front. So that can be quite attractive. Alternatively, if you're leasing the asset, you're effectively just renting it. You don't own that asset. You don't own it at the end of it. You're basically just paying a rental for the use of it. So every month when those payments come through, you would just claim back the VAT on the payments as they come through. Whereas with hire purchase, you reclaim it up front, and then there's no further reclaims on the future payments as you make them. Personal expenditure is one to be aware of. It's inevitable and it's normal in a farming business that there will be an overlap in personal expenditure. There's a number of things that we're able to legitimately put through our farm businesses that have both a personal and private element. A lot of those will relate to your farmhouse if you live in a farmhouse. So repair costs for the farmhouse, because ultimately your farmhouse is your place of work. It's the equivalent of your office. So we have farmhouse repairs, electricity costs, telephone costs, internet costs, those sorts of things. Professional fees is another one that we should maybe consider. You pay your accountant a fee every year. They do your accounts, which is a business expense, but they do your personal tax return. That's a personal expense. So there's things like that that have both a personal and private element. The basic rule to be aware of is that VAT should only be reclaimed in accordance with the proportion of business use that there is in any of these scenarios. Now, saying that, HMRC have got some general guidance on what is acceptable. So for things like farmhouse repairs, normally we're able to reclaim between sort of 40 and 70% of the VAT. If you're a full-time farmer, generally speaking, you can claim up to about 70% on your farmhouse repairs. So if that's something you need to know more about, it's worth speaking to your accountant and getting a bit of advice on that. So in the interest of time, I will keep moving on. We've got our business structure from last week. We've got our record keeping in place. We know we've signed up for VAT. We know what scheme we're going through, and we now know what the main rates of tax are, for each of the different assets, for different inputs and outputs that we have. What's the deadlines? So regardless of whether you complete monthly VAT returns or quarterly VAT returns, you have 1 month and 7 days from the end of your accounting period to submit your VAT return. So if I have a quarterly VAT return that covers January, February, and March, I have until the 7th of May to submit that VAT return. If you were in a position where you had to make a payment, you would also need to make the payment by that date as well. Even if you have no VAT to pay or reclaim in that period, you still need to submit a return, even if it's just to say there's been no transactions, it's a nil return. There has been a change to the rules around penalties for late filing of VAT returns. Historically, because agriculture is generally in a position where we are reclaiming VAT rather than having to pay it, it used to be the case that if you were late with your VAT returns, HMRC ultimately weren't that bothered because they owed you money. So actually, if you were late with filing your VAT returns, it didn't really matter because they owed you money anyway. It wasn't that you were owing them money back. That has now changed. We have changed to what's called a points-based system. So this is an automatic thing. For every VAT return that you submit late, you will get a penalty point. Points do not mean prizes. Points lead to penalties. So if you submit quarterly VAT returns and you rack up 4 penalty points, you will incur a £200 penalty. If you submit monthly VAT returns, if you have more than 5 of them late, you will also get a £200 penalty. The penalty points do expire, I believe, after 2 years from when they've been obtained. But if you continue to accrue them, penalties will start to apply. So that's something that's relatively new for agriculture. So if you're behind in your VAT returns, it's not something to panic about, but it's something to be aware of that you'll need to bring them up to date. So we've got all this information. It's gone into our bookkeeping system in whatever format we keep that. But ultimately, there's 4 pieces of information within a VAT return itself. We're telling HMRC how much VAT we've collected for them on our sales, how much have we paid in what we purchased, and how much of that do we want to reclaim. We also tell them what our total sales figure is and what our total purchases figure. So those are the 4 key figures that are reported on the sort of front page of a VAT return. So we've touched on this a wee bit already. Agriculture is in a unique position because so many of our outputs are 0 rated. We are charging VAT at 0% and we're reclaiming at 20% quite often. So it means that quite often we are in a reclaim position. So at the end of the quarter, we accumulate all our transactions and we say, well, actually, what's the net impact here? Like I showed in the example of the gate, we don't pay VAT back to HMRC on individual transactions and then reclaim it all. We summarize it for that monthly or quarterly period. And the VAT you pay is the difference between anything that you've paid and anything you've charged. If you've charged more than you've paid, you need to give it back to HMRC because it's not an income or expense. We're effectively just tax collectors. If you've paid more than you've charged, well, then HMRC will refund you that difference. An important thing to note is that all VAT registered businesses are now captured by what's called making tax digital. It used to be the case that many businesses kept their records in paper format, and that farmers would complete their books in paper, and at the end of every quarter, they would go through their ledgers and they would calculate it all up, and they would find their total VAT repayable or reclaimable figure, and they would submit that one figure to HMRC, and then that would be the process. That has now changed. All VAT registered businesses, regardless of their turnover, have a legal requirement to keep their VAT records digitally and also to submit their VAT returns using a suitable software. So common pieces of software we see would include things like Xero or Sage or QuickBooks. There are many different types out there. My best advice would be speak to your accountant in the first instance, whatever package you decide to go for. If it's not a package that your accountant is familiar with or your accountant regularly uses, it's probably going to cause you quite a bit of hassle. So I would work up their recommendations. The main player in the market at the moment is probably Xero, and that's one that SAC use for all of our bookkeeping clients. But there are lots of products that are available. They're primarily, cloud-based. Many of them have apps that you can use on your phone. In almost all circumstances, you'll be able to get demonstrations of each of these or trials. If you search in the Farm Advisory website, some work has been done to look at different types of software for your farm. There was a whole series that was completed, and that looked at livestock software, arable software, financial software, and some of the different packages for financial software were laid out there. If you don't have an accounting package that you're using already, speak to an advisor, speak to your accountant before taking that on. So making tax digital is the Treasury's first step in the digitization of the UK tax structure. The next step in that journey is making tax digital for income tax. So that's coming in over the next few years, starting with sole traders. It will become mandatory for sole traders with an income of over 50,000 from April 26, and for those with an income of over 30,000 from April 27. That's not in place yet. If it's something that's going to affect you, please seek advice from your accountant. Partnerships will be captured at some point, but HMRC haven't given a date for when that's going to happen yet, just to be aware. So what are the top tips here for keeping on top of your bookkeeping and your VAT? Ultimately, little and often is the way to go. If you leave it, and do it once a year, the amount of paperwork that you're going to have to process, especially if it's something that you don't particularly enjoy, will be overwhelming and you're more likely to make mistakes. Keeping on top of it, monthly would be ideal. Using quarterly check-ins as you're submitting quarterly VAT returns would be the minimum that I would suggest to do. Most accounting softwares allow you to link up your bank directly to the software. So the bank statements are pulled in automatically, automatic bank feeds. This helps keep down the chance of manual errors. Within your software or within whatever bookkeeping system you have, be consistent with how you record your transactions. So I've talked about coding of accounts there. So if you've got machinery costs, make sure you're always posting them to the same place every time. So actually, when your accountant comes to do your year-end accounts, a lot of the work is done for them, and it makes the process smoother. Also, for you trying to use that for management information, it's going to be much easier if you're consistently posting transactions to the same places. Consider uploading PDFs of your bills and invoices into the software. I did mention that already, that keeping records digitally is absolutely an acceptable way to go. And it's a really good habit to get into. It also makes your accountant's job easier at the end of the year. They might not necessarily need to see any records, any folders or paper records from you at all. And it was quite often the case in practice where all I would need would be access to the client's software and perhaps a copy of their bank statement to complete their accounts for a full year. Make sure you sense check your VAT return before you submit it if you are submitting it yourself. Just run through it for the month or for the quarter. Check, are all these transactions expected? Is there anything that's obviously missing? Have I applied the right VAT rate? Have I been consistent in applying my VAT rate? And I haven't put them all under the right headings. Just a bit of common sense there. If there's anything you're unsure about, do seek advice on it. You can absolutely submit your VAT return yourself if that's something you're comfortable doing. But there's absolutely no shame or no problem in getting some assistance in that area if you need to. I do appreciate that's been a wee bit of a whistle-stop tour. We're trying to cover quite a lot of material within a 1 hour session. There is lots of information available on the FAS website under the new entrant section under business skills. This series, as Laura pointed out, is not just for new entrants, but it's for the next generation of farmers. We're trying to broaden that scope. But this is a really useful website to go for further information, whether there's publications on there, there's webinars, video recordings, podcasts, all sorts of useful tools for you to have a look at, and that will give you more information about bookkeeping, VAT, and lots of other topics that we're going to cover throughout this series.